Hi there, it's Bill with Smart Trades. It's June the 19th, after 4 o'clock Saturday afternoon, and quickly we'll take a look at the S&P and then a variety of other markets as well. First, looking at the S&P cash here, the daily chart. Yeah, and my count is that we have a possible ABC down, which I prefer to call A, that we're going to rally back up and are in a rally back up, which I'll label as B tentatively, and we'll take this one step at a time, but we've got a variety of targets up here, assuming that this is an ABC rally, the first of which is a 62% retracement of this entire decline, and 1.62 times A. Those both come in a little bit over 1140, so that's an area to watch. There's also what I call a secret gap. You can't see it on the S&P cash chart, but believe me, it's there a little higher up, closer to the 1160 area. We'll get into that on the next page, but quickly let's take a look at the alternate counts here. Some folks are calling this a series of 1-2s down, relabeling A1, B2, C as another one, and then this rally back up is 2. The problem I have with that is that so far this second rally is larger than the first. The other scenario that people are looking at is that this decline is a leading diagonal triangle. There's some major problems with that as well. Probably the biggest one is that the fifth leg or last leg in the diagonal triangle did not make a new low. In fact, neither of the second legs down made new lows on the NASDAQ cash, or futures for that matter. So 2 out of the major 3 indices are not following that pattern, basically in that they should be connecting to this trend line that would connect these 2 legs down. What I've got labeled as A and C, and you're nowhere close on the S&P or NASDAQ cash, daily, hourly indices, whatever. Anyway, here's the S&P cash. I think that the current pattern we're in right here labels as a small degree wave 4. We can argue about the details of how to count this rally out, but I do think that this is a small degree wave 4, and there's even a contraction on the advanced decline line. Here again is that secret gap that I mentioned. This is the spiders, and you can see that indeed they gap down back off the close on the 13th. You cannot see this on either the S&P or the Dow cash. The reason for that is those indices use unchanged issues to calculate, unchanged and untraded issues, that is, to calculate their opening. And so oftentimes gaps that are very real in terms of market activity don't show up the way that the Dow and the S&P are calculated. And here you can see that that gap comes in around 116 basis the spiders. Here again is the S&P cash hourly, our calculations and the count ABC that we're working on, and again no gap at the close of the 13th. Here's the Dow, again no gap, same pattern off the lows A, B, and the tentative target is about 10,685 basis, the Dow for the 62%. The gap would take us a little higher, perhaps up to that 10,700 and change level. But we'll watch to see how it plays out. The gaps in the 60, the Fibonacci ratios are not super important in and of themselves. It's more important to watch for the pattern. Here's the dollar index daily. There's a variety of counts out there on the dollar index. One of the problems I have with labeling this as 1, 2, 3, 4, 5 is that the corrections aren't alternating. Indeed, if you look, we've got basically zigzag corrections off of all of these rallies. So I've labeled this as a series of 1-2s, and the center point of a third wave coming in here. You can see the peak volume and peak momentum coming in on the rally into early May. And the current decline, I believe, is possibly a fourth wave. It's been fairly sharp. However, if you look at the previous fourth wave low, so far we're holding that. So we'll see. I mean, if it takes that out, obviously it may be something else, but certainly worth watching here, since so far we're holding right at the previous fourth wave low. And you can count this as a series of 1-2s, which would make the current decline a 4 and probably a relatively shallow affair. Here again, the dollar index, and here's the midpoint, the 50% point of that third wave. This is interesting because, and this is actually something I learned from Prechter years ago, oftentimes that midpoint of the third wave is also the midpoint of the entire move. So if this is 50%, the entire move, or at least this entire impulse wave, would target somewhere up around the 94.70 area, basis the continuous futures on the dollar index. And here again, this is a somewhat different count than a lot of folks are looking at. That would give us the similar legs up off of the low back in 2008, which you could label A, B, and if you have a 5-wave completed pattern here, that would label very well as a possible C wave. So it's something to watch for in the coming months. And here is the monthly dollar index, and possibly you can count this contraction here as also as a fourth wave. It's rather large relative to the rest of the decline. Nonetheless, a smaller degree fourth wave also comes in around that 94.75 area, the top of that fourth wave, which is natural resistance. Additionally, that's a 38% retracement of this entire decline. And again, that's approximately where you'll have an A equals C, a classic flat pattern, just under the 95 level, basis the dollar index. Here's a quick look at crude. I'm counting crude as being in a fourth wave and possibly a wedge C wave. So if this does play out, this will be an interesting place to watch, around 80 or so basis the crude oil futures. And if it is, that you probably should have a fifth wave down to new lows, but we're a little too soon to tell. And finally, here's gold. One of the things I'd like to bring your attention to on gold is that a lot of folks, famous and otherwise, had labeled this the late 2009 peak as the high, and even after the market declined in what to me was a clear ABC, they were still labeling that as the top. To me, you know, that's a problem in that you're just not taking things one step at a time in terms of counting the market and counting what's actually there. Indeed, I also counted this incorrectly. I thought this ABC decline was part of a larger triangle, perhaps, and that has not been borne out. But that said, if you look at this decline and the ensuing declines as on the way up, they're all very clearly corrective ABC classic Elliott wave patterns, all zigzags, and becoming smaller and smaller in magnitude and leading to that final new high. That said, this new high is we're getting diminished volume and momentum here, so certainly worth watching for a possible peak at moderate new highs, and perhaps we'll get one more leg up to form a nice diagonal triangle type peak. But the other thing too, volume this time of year needs to be taken with a grain of salt because everybody's taking summer vacations and so on. Volume naturally dries up. So just the fact there's a volume divergence doesn't necessarily prove anything. Anyway, that's about it for now. Hope you're having a good weekend and a good week ahead.